Good evening, ladies and gentlemen. It is my great honor and privilege to moderate this session. The session title is Currency War. For today's panel discussion, we have invited three internationally renowned scholars as panelists. They are Professor Eisuke Sakakibara, sitting in the center. He's from Japan. And Professor Eswar Prasad from USA. Actually, every country manipulates its currency, and we call it manipulation, but they call it economic policy. Now, but the main problem is with the argument in favor of macroeconomic policy, currency manipulation starts out okay, but it ends up with retaliation. The currency war can extend to trade war, which may lead to, or may not, to the collapse of the international monetary system, which a lot of people are concerned, actually. Now, before we start our discussion on the currency wars, we need to have basic understanding of what is about the currency wars. As I see it, the currency war has multiple features. Number one, it is a central bank that takes part in the currency war. Number two, the central bank expands money supply to stimulate its economy, hoping the money expansion will lower the interest rates and cheapen the currency value. Number three, the central banks of China, BRICS, and other emerging economies directly purchase the US dollar in the exchange markets and build up foreign currency reserves. Now, having figured out the essential features of the currency wars, I'm ready to ask questions. My first question is about quantitative easing, QE. The QE had not been introduced in the economics textbooks until the Bank of Japan adopted it in March 2001 to fight against domestic deflation. When the short-term interest rates do not move, the central bank tries to lower longer-term interest rates by purchasing more government bonds and purchase the asset-backed securities and equities. According to a record, however, the BOJ, the Bank of Japan, claimed that the QE then was not effective and rejected its use for monetary policy. Nevertheless, during the global financial crisis of 2007 and 2008, QE was adopted by the US, UK, Eurozone. Students of economics learned from their textbook that the central bank can expand money supply for a stabilization purpose. One cannot blindly criticize QE policy of other countries because all sovereign nations can exercise monetary policy of their own. The conventional monetary policy and quantitative easing are similar, except that under QE, money can be supplied almost with no limitation. Now, having said this, my question is addressed to Professor Prasad. Has the QE been effective or successful in the US? What have been the challenges? Can you tell us?
It depends on what you mean by success.
Or effective.
There are many dimensions in which one could evaluate success of quantitative easing in the US, and it's useful to think about what exactly quantitative easing has implied and why it was undertaken. It was largely because there was little room for conventional monetary policy operating through the interest rate channel. And in the US, it's really not the exchange rate channel that gives you that much traction. So at least in the context of the US, the currency war component was somewhat more limited. But if one was to think about evaluating whether QE was successful, it's important to set out a metric. And the metric ultimately would be determined on the basis of what the central bank in the US, the Federal Reserve, has in its mandate. So the Fed has a dual mandate, of course. One is price stability, essentially low inflation, and maximum employment consistent with price stability. The financial stability mandate is sort of lurking around in there, but it's not really part of the official mandate of the IMF, of the Fed. So if one thinks about whether QE worked, all the academic evidence points to QE being successful, but being successful in one very specific measurable dimension, which is its effect on financial markets. And there it does seem to have worked. It does seem to have worked in supporting asset markets, very broadly speaking, and it does seem to have helped in terms of keeping interest rates relatively low. Of course, there were many elements to keeping interest rates low, not just at the short-term end driven by policies, but also at the long-term end, especially through forward guidance. But the question that ultimately remains is whether it feeds through into the two key indicators that are part of the Fed's mandate, employment and inflation. Now, if you look at the overall outcome in the US economy, one would be tempted to say that QE did work, because after all, inflation in the US is getting close to its target level. The US economy does seem to be generating robust employment growth, and the unemployment rate is below traditional measures of the non-accelerating inflation rate of unemployment, or the natural rate. But it's been very difficult to establish a clear connection between asset markets and operating through the wealth effect having an effect on consumption. And if one starts breaking down the data more carefully, then some troubling factors start showing up in the data. It is true that GDP growth in the US has not been as robust as employment growth, but it has done relatively well. Yet, if one looks at where GDP growth came from, it's largely been in terms of consumption growth. And what is necessary for a durable recovery, for durable growth, of course, is investment growth and productivity growth. And both of those continue to languish. So one has to ask the question, did QE really work in terms of generating the right sort of foundation for good growth? Now, if one thinks about how macroeconomic policies are meant to work, in principle, it's structural policies that determine the supply side of the economy, and macroeconomic policies, both monetary and fiscal policy, that affect the demand side of the economy. Of course, the problem is that these are very difficult to disentangle in the short run, and demand deficiency can very soon translate into a reduction in the long-term growth potential of the economy. And I think that's the real concern right now. Even if operating through the wealth channel, you did have a positive effect on domestic demand, whether it is the right sort of domestic demand that is going to improve the productive potential of the economy is an open question. And I think to that, at least as far as anecdotal evidence goes, the answer doesn't seem to be a resounding positive yes. In fact, I think there are many reasons to be concerned that the wealth channel has not really worked in terms of helping the productive potential of the economy, and what we are seeing in terms of short-term domestic demand doing quite well might be something of a mirage.
Okay, well, then you and I understand that the US Fed's mandate is the maximum employment and the price stability. So based on that criteria, can you say that the US has been doing a QE for several years now, so US experience, still it's going, but QE has been effective or successful? Can you say that?
If you think about the unemployment rate being at 5% right now, if you think about the economy generating an average of about 200,000 net non-farm payroll jobs month after month for a very long period, of course, with variation around that number, that is a fairly remarkable outcome, especially because we're coming out of a financial crisis. But again, as one starts looking more closely at the numbers, the fact that the labor force participation rate is still about 2.5 percentage points below where it was back in 2007. Wage growth still remains weak, although it is picking up. Clearly, the labor market has not fully healed, although it's certainly a long way from where it was back in 2007 or 2008. So I think the sense that this is all due to QE may be a bit of an oversell, but certainly QE helped. But the US economy is fundamentally a very resilient and flexible economy. So in the US, monetary policy, and it was ably aided by fiscal policy in the early years of the financial crisis, before fiscal policy started actually withdrawing stimulus. But in the US, the need for structural reforms, except in the financial system, has not been that great. So I think the US is a very specific economy where QE had a better chance of success because it was a more flexible economy and where the structural problems were not as great as in many other economies.
Okay, now I would like to call on Dr. Sakakibara and ask you a similar question. Now, Prime Minister Shinzo Abe has been pushing hard abenomics since December 2012. Abenomics is based on 3 arrows: fiscal stimulus, monetary easing, and structural reforms. Now, has abenomics been successful overall? If not, what were the reasons? Now, structural reforms are inherently very difficult to accomplish, let alone the fiscal stimulus for any country. So they can hardly raise corporate tax or income tax. Now, if the abenomics is not going to be successful, do you have other alternatives to put your economy back on the normal track?
Well, my view is abenomics has so far been quite successful, primarily due to aggressive easing of monetary policy. Current governor of Bank of Japan, Mr. Kuroda, was appointed by Mr. Abe in March of 2013. Right after he took the office, he implemented very aggressive easing of the monetary policy, which led to depreciation of the currency toward $1.20 and resulted in increase of equity prices by 60%. So that, quantitative easing, aggressive easing of monetary policy has been quite successful. And that has lifted the Japanese growth rate in 1913, 1914. 2014, we had a raise in consumption tax. So the economy did not really grow that much. But I think overall, aggressive easing of the monetary policy so far has been quite successful.
That's good. Our second round. The second question is about the reserve currency. The reserve currencies are the currencies that are held in significant quantities by governments and institutions as part of the foreign currency reserves. They are the US dollar, the euro, the UK's pound, the Japanese yen, the Canadian dollar, the Chinese yuan, renminbi. The reserve currency countries can enjoy the seigniorage benefit because other countries hold them for a significant period of time. At present, the US dollar is the most widely held currency. There is a speculation that the seigniorage benefit that the US acquires is in excess of $100 billion a year. However, there will be enormous cost or burden to the US as well. So, Professor Prasad, would you tell us more about this issue and the role of the dollar? I understand you have published a new book, the US dollar. So I guess that book has some bearing on this issue. Please.
Today is an important day, not for the world, but for me, because my new book on the RMB is officially published in the US today. It's called Gaining Currency, The Rise of the Renminbi, so I'm well positioned to think about this. It's useful to draw a distinction among different concepts. First is the notion of an international currency, one that is used widely in trade and finance transactions. And there, the RMB has gotten some traction. After all, China is now the second largest economy in the world. It accounts for about 12% of global goods and services trade. And just because of its sheer economic clout, its currency is becoming more important. It's certainly not rivaling any of the major currencies, but going from accounting for basically 0% of payments in its currency to about 3% of payments, worldwide payments, being transacted in RMB in a period of just about 5 years is a remarkable achievement. And if China continues with its economic and financial market reforms, I think it will start playing an important role as an international currency. An important qualification here that there is a third concept here, which is that of a safe haven currency. Until the renminbi came along, there was no difference between a reserve currency and a safe haven currency because all the reserve currencies that we see out there today are basically safe haven currencies. What accounts for the distinction? I argue in my book, in actually both of my books, that what is necessary for a currency to become a safe haven currency is that it must have the trust of foreign investors. And that requires an open and transparent system of government, the rule of law, and trusted political institutions such as an independent central bank. China has made it very clear that it is moving forward an economic and financial market reforms, certainly in a very slow, haphazard way, but it is moving forward. But in terms of broader political, legal, and institutional reforms, President Xi Jinping has made it very clear that these are off the table. So my sense is that the renminbi, if China plays its cards right with economic and financial market reforms, will become a significant international currency, could become a significant reserve currency, challenging perhaps the yen, perhaps the pound sterling over the next decade or so. The chances that it will become a dominant reserve currency that will rival the dollar, I think, are virtually non-existent.
You know, someone was concerned about the fact that currently, as I mentioned, China is holding, more than 3 trillion, foreign reserves, and most of them, say, in the form of dollar. And what if China does something like, changing their portfolio composition, so they're releasing their, dollars into the currency markets, then the dollar value will plunge, So they can manipulate it, for political reasons or the diplomatic reasons. What if that happens? The U.S. will be hurt to a great extent. So what do you say?
Going back to the reserve numbers you spoke about earlier, you said that China now has $3.2 trillion of foreign exchange reserves. In June of 2014, they had 3.994 trillion. They didn't quite get to 4 trillion. But since then, they've actually lost $800 billion worth of reserves, trying to protect the currency's value from depreciating, because things have changed in China. They were accumulating reserves when there were pressures on the currency to appreciate. Now it is depreciating. And in fact, the world, the US Treasury and the IMF had for a long time told the IMF, let your currency's value be determined by market forces, because they presumed that would mean the currency would appreciate. China brilliantly did what the world wanted it to do, but at a time that suited it, when the RMB was depreciating. So then, the G20 in its infinite wisdom and the US turned around and said, yes, all these years we've been telling you, China, to let your currency's value be market determined, but please, don't do it now. So in fact, China has been intervening in foreign exchange markets, losing reserves to keep the currency's value from depreciating. Has this affected the dollar's value? Not in the least. And if you think about where China could go with its money, let's say it decided that it wanted to take a couple of $100 billion. Where could it go? Could it go into euros? Could it go into Japanese yen? Could it go into gold? All of these markets are much, much smaller. So the reality is that, and this was the whole point of the dollar trap, that there is no other place to go. And we've seen repeatedly that when countries like Russia said they would pull out money from US dollars, concerns that their Saudi Arabia might start pulling out dollars, in every one of these instances, when there was a threat, the dollar, if anything, strengthened slightly. Why? Because it was immediately apparent to international financial markets that there was nowhere else for these countries to go. And if there was going to be any financial turmoil because of what Russia or Saudi Arabia might do, where would people have to go for safety? Back to the US dollar. And this, I think, is a crucial difference between the renminbi and the dollar right now. If there is trouble in China, money goes out of China. If there is trouble in the US, money comes to the US for safety. I don't see that changing.
So we should not worry about it, because China will not do it, because they would do it, it may hurt the US economy, but it would hurt China too. So they may not do it, right? Okay, so now I would like to turn to Dr. Sakakibara. Japan's yen is another influential reserve currency. It is the fourth most commonly held reserve currency. Also, it is a part of the International Monetary Fund's special drawing rights valuation. Now, what do you think are the benefits and costs of the Japanese yen being an international reserve currency?
Well, my view is the only effective reserve currency is US dollars. Sure, some portion of foreign reserves of some country is held in yen, but majority of foreign reserves of most of the countries are held in US dollars. China and Japan have huge foreign reserves, but most of them are held in US dollars. So that, yen being called the reserve currency sounds somewhat, strange to me. It may be held in small quantity as a reserve currency in some countries, but this is a dollar-dominated world. So, although yen is a safe currency, which could be held in some small portion in the foreign reserves, the world goes with US dollar, period.
Okay, that's a fair statement. Now we are at the third round of discussion. Many people understand the expansionary monetary policy being pursued by the reserve currency countries, but they are worried about the collapse potential, collapse of the current international monetary order, or they want to see some reforms being done with respect to the IMF, or at least they are not, they don't feel comfortable with the current, many people, although you folks, have strong confidence and no problem with the current economic, global monetary system, but it is true that many people are concerned about the flaws in the international monetary system. Now, from that standpoint, they want us to seek measures to avoid any, global financial disaster that's maybe coming or not. If it doesn't come, we're so happy, but if it is coming, we don't want that see happening. So, Professor Prasad, can you suggest or tell us anything that we can do, to soothe or to comfort the people who have, such worries?
So one question is whether if one was starting with a blank slate, whether we would design a monetary system that looks the way it does right now. And to most reasonable people, the answer might be no. Having a unipolar system where one currency dominates the way the dollar does, at times of crisis may not be such a bad thing because, when the financial crisis hit, there was panic everywhere and there was no trust. And having one currency that everybody could trust at some level prevented things from getting much worse because everybody wanted dollar liquidity. The Fed was able to provide very large quantities of dollar liquidity, and that kept things from getting a lot worse. But of course, one could flip that around and say, the reason we ended up with the financial crisis was because one country at the core of the international monetary system was allowed to run very undisciplined policies for a long period. But we are where we are right now. And the question right now might be, if one goes back to the theme of the session, which is currency wars, is there something wrong in the international monetary system right now where we end up with countries trying to depreciate their currencies against each other? And is there a way one could have a coordination mechanism or an international mechanism to prevent this from happening? For a country like Korea or for many other countries in the region, it's a real whiplash effect they're feeling right now because it looks like the US might start entering its tightening cycle sometime in the next few months, while the Bank of Japan and the European Central Bank are looking to ease policies even more, which may suit these countries well, but it creates this enormous capital flow and currency volatility. And, countries like Korea, Thailand, India are stuck as innocent bystanders caught in this whiplash effect. But what is the solution here? I think rather than thinking about international coordination to fix this, what I've argued is much more important is to think about the coordination of policies at the domestic level. What is happening in most of the major advanced economies and many emerging market economies right now is an enormous reliance on monetary policy. If one looks at Japan, if one looks at Europe, to some extent the US, and even an economy like China, where monetary policy is doing a lot of the heavy lifting rather than fiscal policy, which I think would work a lot better given that there is room. And monetary policy with integrated financial markets around the world does have spillover effects. So rather than saying, let's try to coordinate monetary policies so that we don't have these spillover effects, I think the right question to ask is, why is there so much of a reliance on monetary policy in every country? So I think the question really is, why isn't there a better coordination of policies, both macroeconomic and structural, at the country level? So I think flipping that around and trying to say, let's create a coordination mechanism or an international governance mechanism to solve the monetary policy coordination problem is, I think, getting it exactly wrong. What needs to be done is to fix the coordination at the domestic or national level.
Yeah, as he said, that monetary policies do have spillovers, and, US QE1, QE2, QE3 had, depreciated the US dollar to a significant degree, and through the exchange rate, it has affected the rest of the world. And then in the March of 2013, Japan aggressively eased the monetary policy. And that has sort of, had the impact in the exchange rate as well. So that monetary policy does have a spillover and affect the rest of the world. And the rest of the world has to respond to that spillover by their monetary policies. So this competitive easing of the monetary policy is taking place in the world right now, US and Japan and Europe. And this needs some kind of coordination, I think, international coordination of monetary policy. I don't know how we do it, but central bankers could get together to talk about, impact of, spillover of easy monetary policy or tightening monetary policy to the rest of the world.
Would the G20 meeting be
G20
helpful?
or G7, G8? Yeah.
Okay, now, see, in the eyes of a Korean economist like myself, things are not quite fair in the sense that China's, has been running surplus all the years, and they built up so much of foreign reserve currencies, and they are now engaged in aggressive QE, quantitative easing. So their currency is not really appreciating. Whereas Korea is suffering, so low growth problem, and the price is stable, but because of the surplus in the current account, the Korean won currency is a bit, stronger. So Korean businessmen is really puzzled, what's going on in the world arena. So these countries, reserve currency countries, are doing whatever they want to, or in terms of expanding their money supply, whereas there's very little we can do about it. So perhaps, Professor Prasad, you can tell us something we could do, Korea, how to overcome these problems, employment problem, and low growth, and then we are about to suffer from, say, trade balance. It's going to be, going into a deficit. So could you, tell us what things we can do?
That's not an easy question to answer. I think it's always easy to wave one's hand and point to structural reforms to improve competitiveness, and I think that is an important part of the answer. If one thinks, again, it's not just Korea, but in many other economies, the key issue is how does one improve the productive potential of the economy, and when you ask the question that way, it immediately leads you into thinking about, parts of the economy where you could get significant improvements in terms of the structure and flexibility. But that's not going to be all of the answer, because Korea can do everything right and still get hammered by what happens with the monetary policies, in particular of the big economies, and not just advanced economies, but even an economy like China. And this is where, actually, going back to the question you asked me earlier, one could think of mechanisms in order to try to at least reduce the need for countries like Korea and many other some emerging market economies. Korea is no longer an emerging market economy. For these countries not to have to rely on self-insurance through reserve accumulation in order to deal with this capital flow and currency volatility. But the classical answers one used to have for this, and I've propounded the classical answers myself, that you need to have well-developed financial markets, that you need to have better regulated financial markets, because then capital will come in and increase the productive potential of the economy. That doesn't quite work either. Malaysia is an interesting case in point. Malaysia, during the period right after the financial crisis, when there was a lot of quantitative easing by the major central banks, got a lot of money going to Asia because there was a desire for yield, and Malaysia had the most open and well-developed financial markets, so they got a lot of capital inflows, and then a lot of that capital flowed out when it looked like the Fed might start raising interest rates. So that answer, in fact, didn't work very well. Having very well-developed financial markets exposed Malaysia to even more volatility. So I think we're going to require a mix of two things. One is fixing policies at the domestic level. Korea can do certain things, but ultimately, until the major economies get their policies right, it's going to be very difficult to protect the smaller economies. And second, one has to think perhaps not about a coordination of policies, but at least safety net mechanisms. And I know that Korea, during its presidency of the G20, did try to set this up, perhaps an institutionalized mechanism of swap lines, for instance, where you wouldn't have as much reliance on self-insurance through reserve accumulation, which then keeps the reserve currency economies, again, facing their own problems. So it's got to be a combination of these two. And right now, I think we are seeing neither of these happening. Neither do we have policies at the domestic level working very well, nor do we have the international governance mechanism working very well. So I'm not very optimistic that there is going to be an easy way out.
Okay, Professor Sakakibara, could you suggest anything for us?
To improve the international financial system?
To improve our economic conditions.
Well, one thing that we need to recognize is the reality of the world financial market. This is dollar-denominated world. You know, U.S. takes the lead. Whatever a U.S. monetary authority implement does affect the rest of the world. And U.S. does have that kind of prerogative. U.S. is the only country which could run continuous balance of payments deficits because U.S. dollar is a key currency in the world. So that reality needs to be recognized, you know, when we think about, you know, reforming the international financial system. The reality is that it is dominated by the U.S., and that reality would not change. Whatever IMF thinks of in terms of the structural reform, the international monetary system. And, you know, something like renminbi being included in SDR is an interesting event, but that would not make the renminbi the reserve currency for some time to come. Maybe 40 years, 50 years from now, renminbi would become a genuine reserve currency. But we need to recognize the fact, the reality, that it is the dollar-denominated world, and it is dominated by monetary policy of the United States.
The World Knowledge Forum